Hello everybody and welcome to the PIIverse. My name is Perry and I will be your host today. It's been actually quite a while since my last video. Well, I'm going to say almost 3 weeks. No, I've not been hiding because I'm scared of the boogeyman bears, although who likes them anyways. But I have been enjoying the warmth, sun, and seas of the Mayan Riviera for over 2 weeks and just returned this week. So looks like while I was enjoying the warmth and the sun, the crypto chill and downturn of 2026 has started to show its ugly head. Anyways, this is basically my monthly month-end review of my portfolio. I was on vacation until, like I said, just a couple days ago, so I'm a little late for my month-end review. This is my January 2026 month-end review, and the theme to this one is my portfolio in the first signs of the 2026 downturn. So let me show you how my portfolio basically performed through January of 2026, some of the activities, and where I'm standing right now. So let's get started. Please take note of the following disclaimers. This channel does not provide financial, investment, or tax advice. I am not a licensed advisor or registered professional. I am a retail investor sharing my personal opinions, experiences, and lessons learned along the way. Nothing in this video should be interpreted as advice or recommendations. Every viewer is responsible for their own research, decisions, and outcomes. Your financial situation is unique, and you should always consider speaking with a qualified professional before acting on any information. I might be right, wrong, or somewhere in between. They are just my personal perspectives as an individual investor. As such, all content in this video is for education, discussion, and entertainment purposes only. Also note, past performance does not ensure future results. Thank you. Alrighty, so now that we've done our disclaimers, and they're very important, so you should always be taking note of them. I know a lot of people want to skip by them, but please take note of those disclaimers. They're very important. Anyways, let's start, like I always do, with an agenda of what we're going through. And again, I want to clarify, this is my month-end review. I try to keep it very structured. This is basically following the same format I do every month, always doing little tweaks here and there, but generally I follow the same format. But let's go through what that agenda format is. We're going to start by doing an introduction and a portfolio background because not everybody knows me that well. And if anyone catches this as my first video, they're going to want to know about my background of my portfolio and when it started and who am I. Then we're going to do basically the January 2026 highlights. What are the activities that I did throughout the month of January? And yes, I was on vacation for over 2 weeks, but you know, the nice thing with technology, if there were opportunities to do buys and sells and watching the markets, I can do it on my phone while I'm watching the ocean's waves splashing up on the shoreline. So I did do a lot of that. It was actually a very busy month for me. So we'll go through that. And then basically I do what I do every month, and that is comparing the previous metrics, key metrics, to the current month-end metrics, just to show where I've shifted positive and negative from month to month. If anyone ever wants to know, you can look at all my month-end reviews and you can see this previous month to current month metric comparison. So we're going to go through that. Then we're going to do a quick look under the hood of PIIverse. I used my Snowball Analytics portfolio to show a little bit more detail on some of the things that I may have just glossed over in the previous slide. Just want to show some highlights on there and stuff like that. So that's what we're going to do with looking under the hood of PIIverse. And then finally, we're going to conclude by my looking forward and my conclusions before we end this video. So let's just get started. All right, so beginning with an intro and a portfolio background. Like I said, at the end of each month, I do produce this month-end review of my PIIverse passive income portfolio. This is what I do every month, so it keeps people on the flow that keep tracking how my portfolio is going. This one is the January 2026 month-end review. I do want to clarify that I was on vacation until only a couple days ago. So some of these metrics are not accurate to the point of end of January or the first day of February. They'll be skewed because the markets have been extremely volatile over the past few days. So my metrics are going to actually be reflective of February 5th, which is today, the day I did the video, because my Snowball analytics cannot backtrack back to a previous date to say what was I like 5 days ago. So just keep that in mind, even though this is a January 2026 month-end review. All right, for those that don't know who I am, let me quickly go through this background of my PIIverse income portfolio. I retired 2 years ago, a little over that, October 2023, and this income portfolio funds my entire retirement, other than a little CPP from the Canadian government, which is very little. I'd say 99% or 98% of my entire retirement is funded by this portfolio. The portfolio was built through 2023. I actually started transitioning it from all my bank managed investment accounts and cashed out my pension through 2023. And so basically through 2023, I went from this portfolio never even existing in February of 2023 to basically getting to a point which was in cruise control mode by November. And I think I actually just said that here. November 2023, I consider this portfolio was completed in its build phase and was actually in basically its cruise control or maintenance or going forward mode. So everything I do as a metric below is based on the metrics as of December of 2023. So back then, my initial NAV at that time when I started my portfolio was $1.28 million. By the way, I'm Canadian, so everything you see from me is Canadian funds. My first full month of distributions back in December 2023 was $19,000. It was an approximate yield of about 18%. This is a fully self-funded portfolio. Because I'm retired, I do not feed it in any more external sources of income. There are a couple exceptions because, unfortunately, sadly, my mother passed away, so there's inheritance money that might be coming in and stuff. But generally, for the most part, this is a self-funded portfolio, and there are no external sources of income that feed my portfolio other than these rare exceptions, such as what happened last year. Okay, my portfolio is in full consumption phase. Annual withdrawal rate of about 13%. Consumption phase, for those people that don't understand this or are new to investing, there is the build phase or basically the accumulation phase of your investing life, and then there's the consumption phase. I am in the consumption phase, meaning my portfolio is actually servicing me. If I was 30, 40, 50 years old and I was employed and I was contributing into my RRSPs and my TFSAs with my employment income, that is the accumulation phase or the wealth building phase. I am not in that phase. This portfolio is clearly in the consumption phase. So its entire strategy is designed to generate income so that it can service me. I am no longer servicing it. It's now contributing and servicing my investment needs because as I said before, my entire retirement is actually funded by this portfolio. And that annual withdrawal rate as of right now is approximately 13%. Just to give you a heads up, in 2026, I'm going to be moving that up. I'm likely moving my annual withdrawal rate on my portfolio to about 15%, but currently it's at 13%. General numbers, just so you know, a thumb in the air. In 2024, my portfolio withdrew about $240,000. In 2025, the withdrawal was roughly around $180,000. It was a quieter withdrawal rate in 2025 than it was in 2024 because we did a lot of bucket list items like doing a major kitchen renovation, buying a hot tub. So basically, my portfolio had a lot more withdrawal demands against it than 2025. So that is why you saw a drop in my withdrawals from 2025. It will likely be going up slightly in 2026. As I said, I'm moving my withdrawal rate back up from 13% to approximately 14-15%. All income produced, all my income producing cover call ETFs are in sheltered accounts. So they currently are in all my RIFs, my LIF, and my TFSAs. Again, for those that are not Canadian, a RIF is a retirement income fund. A LIF is similar to a retired income fund. Basically, any money coming out of it, everything in it that's generated, capital gains, income, is tax-free, but you are taxed when that money actually is withdrawn from it. That's when you're actually taxed. And in Canada, the TFSA, which is a godsend to us, this is a tax-free savings account, of which when Canadians put money into it, all money inside there, capital gains and income, is tax-free. And the money that's withdrawn from it is tax-free. And actually, the withdrawn money is actually then added to next year's contribution levels, so we could actually put the money back in. So that is what it is. Currently, I do not generate any income in a non-registered account. So taxes are not a big issue with regards to the taxes on capital gains and income generated from distributions. The taxes are incurred when it's actually being withdrawn from my RIFs or my LIF. Approximately 85% of my portfolio is covered call and other derivative ETFs or income generating ETFs. The other 15% is pure growth, high torque growth stocks. So I am a hybrid investor, even though I am absolutely centric on income generation. But 15% of my portfolio is on capital gains and capital growth from my high torque stocks. I'll call them higher volatility risk stocks, but they are growth stocks. There are no dividends coming from them. All right, so that is the history of who Perry is, Mr. Retired, and living on his income portfolio. And now we're going to actually do the review of the portfolio as of, again, February 5th of 2026. Ignore the chart. I got to go up here. We'll do that later. So my annual maximization is the first thing that happened in 2026. I maximized my TFSA contributions from my RIFs and my non-registered into my TFSAs. Again, for those that don't know the Canadian system, TFSAs basically expand their contribution headroom in January of every year. So usually Canadians that have extra money and are maxed out on their TFSA contributions, this is the month where they can add more to it because the government gives us another $7,000. And because my wife and I are two individuals, that's 2 times $7,000. Plus, as I mentioned earlier, any withdrawals that took place last year or in previous years are re-added back as contributions. So for me, because I'm an income portfolio, my TFSAs do occasionally throughout the year take withdrawals out to help pay for retirement. And so if you add the added headroom plus the withdrawal headroom that gets re-added, I was able to recontribute back in January $55,000 into my TFSAs. So January, here are the activities that happened through January regarding reinvestment and rebalancing moves. First of all, major rebalance, something that I made a decision, and it's part of my strategy that I've been talking about. I've closed my long-held ex-global USCL position, something I had for almost 2 years, and moved those funds to buy into a new TAP Alpha TSYX ETF, an American one. It's actually a bit weird because I was wanting to move more of my ETFs towards the Canadian ETFs and away from the American managed funds. But in this case, I did move it because it offered a higher yield than the USCL did. I already had HYLD, so I didn't feel that there was any value in having both HYLD and USCL, which are pretty much the same. One is hedge, one is non-hedge, but I did like HYLD better. So I closed my USCL position and I moved that money into TAP Alpha's new leveraged S&P ETF. They've been very successful with their non-leverage, and I felt a level of confidence that they're going to do well with their TAP Alpha TSYX ETF, so I wanted to have a position in that one. So my USCL position proceeds moved into that one. I believe it's around a 19% yield that I'm going to be getting from it, and we'll see how that one goes. I could be right, I could be wrong. Again, no one should be following me. Do your own research, as my disclaimer says, but this is the decision I made, and we'll see if I made the right decision or not. The other thing is I did a lot of reinvesting regarding my TFSA contributions. Again, not reinvesting as part of my regular monthly thing that I do every month like I do in 2025 and 2024. This is reinvesting that was required because my TFSAs received, again, around $55,000 in contributions. And that came basically from my RIFs and my RIFs payouts, and from my non-registered that capitalized some gains, and they basically transferred that money in. So I did a lot of reinvesting of my TFSA contributions. For the most part, the 3 ETFs that benefited from that, all of them anchors. If you don't know what anchors are, I'll show you later what they are. But they were the Evolve Canny, INTI, and UTES ETFs. Again, this is all part of a strategy that I started already back in November last year, where I've decided to move my portfolio to be less aggressive, more towards the anchors and less away from boosters and juicers. And so it's not surprising, as part of my strategy for 2026 of moving more towards a conservative portfolio of anchors. A Canny, INTY and UTES were the recipients of the contributions for the most part. I also had some major wins. I called it a swing buy and 2 swing sells of my Athabasca oil. For anybody that follows me, they know that I do a lot of slow moving swing trading of my Athabasca oil stock. It's been a huge success for me over the past 2 or 3 years. Thanks to Donald Trump doing an attack of Venezuela back in early January, there was a major oil panic sell on the oil sector, and especially the Canadian oil sector, of which Athabasca is one of them. I saw my beloved stock drop almost like $1 something in price, and I could not resist that panic sell because a lot of these people don't understand how the oil sector worked, and I wanted to take that money away from their hands. So as soon as that invasion happened, I bought Athabasca as much as I could for around $6.58. It ended up going down as low as $6.33. 3 weeks later, the stock almost hit it actually did hit its all-time high. And not only did I sell the same stock that I bought only 3 weeks earlier and made a nice, cool $2,200. I think it was $2,300 just from that. I also sold off some of my existing positions of Athabasca as it reached its new high. So I capitalized on a lot of gains. And basically a lot of that money was used to fund my TFSA's 55K contributions. I needed that money so I could move it into my TFSAs. So that was a great win on my part. I let the cat out of the bag. It happened again just a couple days ago. So I actually had another swing sell only a couple days ago, but I shouldn't be talking about it because that's part of February's month-end review. So Athabasca has been delivering very well for me over the past month and a half in swing trading. All right. I continue to hold back on my monthly reinvesting pace. I did mention it a little bit earlier that basically since about November, in my anticipation, and I'm not, people will say, oh yeah, Perry, you can say that now that it's happening. No, the nice thing about videos, you could look at my videos, you could look at my interviews with people like Paul, you could look at my polling questionnaire that I did back in November and October. I made it very clear that I was very nervous that 2026, it was going to be a bear market year. It was not going to be a good year. I thought that the crypto chill and the tech chill that was starting to show its ugly head back in November, December was a precursor of something worse. And so I made the decision to start holding back my reinvesting pace, starting to build up cash positions, and so that basically, one, if the bear markets of 2026 started really showing its head, I would be able to have a larger cash position to buy into some good deals on some quality anchors. And I'm going to be focusing on anchors, and just keep that money in my pocket and not lose it to the bears. So that is continued to be holding on. I know that makes no sense with regards to the fact that I did a major, 55K reinvestment of my TFSAs, but those were put in place because those contributions had to be basically transferred into my TFSAs, and I wanted to reinvest them. But my reinvestments of my regular monthly distributions going forward, February, March, April, it's not that I won't be doing reinvestment, but I will actually be reducing it and trying to hold a larger cash position. So as I said, as reported in previous 2 months, I was going to reduce my reinvestment pace in my RIFs. So mostly in my RIFs, my TFSAs are usually a little bit quieter. So my RIFs are where I was going to basically hold back on. And again, I said all this here, so I should actually read my own pace. So we'll not talk about that. So the only thing I will be doing, which I didn't mention already ahead of these lines, was that reinvesting is not the same as rebalancing. I will be doing a lot of rebalancing moves. I will be looking for abilities or potential where I can actually start moving maybe some underperforming boosters and juicers and maybe move them into anchors, or jiggery pokery my anchors from anchors that I think are going to underperform during the bear market and move them into ones that might be a little bit better yielding or more solid in NAV positions. But rebalancing is the ability of, as it says, rebalance the portfolio, to realign it, to take advantages of new opportunities, to walk away from higher risk potential. And one of them, this is a February decision, but one of them was already something that happened this week, and that was moving away from any U.S. Treasury-based ETFs and moving them into Canadian, I'll call them aristocrat underlying type ETFs. So those are the kind of rebalancing moves I'll be looking for, and that's what has continued to be happening. Again, moving away from USCL and moving in maybe to TAP Alpha, so I can get a little bit more yield and maybe a little bit more stability. So those are things I'm looking at doing. Again, don't follow me. These are just my opinions and my strategies. Do your own research and do your own rebalancing. Okay. This picture should have showed up now. Unfortunately, my presentation popped it up right away. One thing for those, and I'm going to point it out right down here in the bottom corner. I got to find my mouse. You can see right here. Yeah, there it is. So for those that don't know what my pillars of income investing are, there are 2 videos I put out in about October, November. If you don't know what my pillars of income investing are, these are the 2 videos. I will put a plug right here. If you look up right now, I'm going to show one of them. You can click on it, or it'll hopefully be also in the description. So if you don't know what my 3 pillars of income investing are, this is the videos that will actually show you what they are. For those that do know, this is something I'll be tracking quite accurately now. I've actually incorporated my pillars into my Snowball analytics, which is one of my main investing analytics websites that I use. So if you look over here, and I'm just trying to, if you look over here, again, I stated that I am in a process of migrating my entire portfolio to a more conservative, more stable type of portfolio. For those that don't know me, in 2023, 2024, 2025, my portfolio was quite aggressive. I had an average yield of about 35 to 40%. I am moving my portfolio more towards anchors, which are generally portfolios with yields around 20%. So that is basically what I'm heading towards. And you can now see my monthly progress report. As of December 31st or January 1, my anchors at that time were at 29%. You can see that based on 2 things happening. One, me making a lot of moves of reinvesting from the distributions for the contributions in my TFSAs. into anchor positions, as well as the market turn down. I'm going to now almost pretty much as of today call it the crypto winter that was coming, and the tech sell off, the risk off that's happening right now in the markets are really impacting my boosters and my juicers, which are a lot more volatile and sensitive to market turn downs than my anchors. So for those two reasons, you're seeing a major shift in my portfolio's weighting. So you could see as of January 1, 2026, just a month ago, my portfolio, my anchors were at 29% of my entire portfolio. That has now skyrocketed up to almost 37% now. This is as of February 5th today. It was only 32% as of February 1st. So this one's moving up pretty quickly. I've moved from my target of 33. I am now over my target of 33 to 37%. And I will give you a little bit of a heads up. I am looking at actually moving my target weight on my anchors up to almost 40, maybe 45%. I really do want to move to a lot more conservative, stable type of portfolio income. So I might even be moving this number up, but it has already exceeded my target weight that I set back in December of 33%. It is now at 37% almost. My boosters last month were 24%. It is now 23%. It's moved down a little bit. The one that's really moved down, and again, it moved down as much because of the sell-off, the tech risk off, the crypto winter that's starting to hit. But you could see that my juicers have really dropped from 28% down to 22%. I wanted a target of 25%. Again, when I do a realignment, you're going to see this happening over the next couple of weeks. I will be readjusting my target weights. I will likely be having my juicers down to about 18% over time. And I'm going to have my boosters down to about 20%. I'm looking at having my anchors boost up almost into the 40s. So that's my target. My growth stocks, which is basically 3 stocks only. You can see it says 3 items in there. My growth stocks are basically at 15% target, and it was much higher. It was at 16.7 back in January 1. I was up to about 18% until only a couple weeks ago, because as I point up above, remember I said I had some major swing sells of Athabasca selling. I think I sold around 530, about 8 or 9,000 of my shares of Athabasca, which brought me down to closer to the number it's supposed to be at. But the nice part is I made some major capital gains and trimmed my gains on this one. So I'm back down to about what I want with my growth stocks of holding it around 15%. It's at 14.58. And then finally, this is a number that's up and down like a yo-yo. It's up really high right now. You can see in my little chart here that this guy's popping out. My target is to always try to keep my cash position generally very low. I need to change that because I have already stated that my strategy for 2026 is to hold a higher cash position. So I might actually move this up to about 2 or 3%. But right now it's at 1%. I'm at about almost 4% or 3.7% cash position. That is only because I just recently sold Athabasca, and I'm sitting on a lot of its sold proceeds that have not been reinvested back in. Typically, when I do the swing trading, like buying and selling, I'm waiting for another opportunity for Athabasca to drop really low. It looks like with this major sell-off today that it's starting to head in that direction. I just sold it yesterday for $8.32, and it's already, I think, at $8.05 today. So it's heading in the, I know you guys think it's crazy, but when you're swing trading, it's heading in the right direction for me to actually put that cash back in. If it goes down to $7.50, that would be really nice. I would actually reinvest my shares back in and just wait for another all-time high to hit for my Athabasca. Anyways, this is my tracker to watch if I'm heading in the right direction with my portfolio. Okay, let's move on. So I'm going to go here. So here's my what I do, my previous to current month results. So you're comparing December 31st, 2025 to current month, which is supposed to be January 1st. But I'm going to say there was major changes because the market's really sold off a lot just since January 31st. So I wanted to clarify that this is actually from February 5th, not January 31st. So these numbers are actually not reflective of actually an end of month, but it's close. But here's it goes. So the first thing is my book value back in December 31st was 1.905 million. It actually raised up to 1.969, an increase of almost $63,000. Again, the main reason to that is because of my TFSA contributions being reinvested back in, that was sold off and moved into that, as well as just a little bit of my money moved in that I was actually sitting on. So my book value has increased to by $63,000 on my book value. My current NAV has definitely decreased, and a lot of it is because of the crypto tech chill switching into almost like a crypto winter. So last month I was at 1.52 million. Currently, as of today, and it was a big drop today already, it dropped to 1.452 million, a drop of 67,000 over the last 31 days, or actually say 40 days. 37 days, something around like that. So my current unrealized loss from my book value is now at 26% loss. It was at 20% loss. Again, this is reflecting that the bear market is starting to happen, the crypto chill, the tech sell-off, the risk off, all of these things that are starting to happen, in 2026, which I had a gut feel was going to happen, is starting to happen, and this is definitely impacting my NAV. My cash position, which is not a big matter because this number is going up and down. When I closed in last year, it was at 1.8% of my portfolio. It's now at 3.7. But again, that's just because I just recently sold my Athabasca shares, so I'm sitting on a large position. My strategy is to increase my position. 3% might be what I want to actually sit on soon. 3, maybe even 4%. So I'm actually closer to what I'd want to be at, but I would actually want that 3.7 or 4% to be a cash position in my RIFs, not in my non-registered. So it's the devil's in the details there. I'm holding cash positions in the wrong account. I would like to have that kind of cash position in my RIFs where I can take advantage of buying cover call ETFs when they're really good deals. My distributions from last month to this month, as of the end of January, my monthly distributions dropped from 43,000 to 36,000. That is not only because over the past month, the distributions have been lowering. I have seen them. The juicers and the boosters have definitely been lowering their monthly or weekly distribution numbers. So that is one factor of it. The other factor is also the fact that December had several ETFs that were 5-week periods. January had almost none of them. So it was another reason. 43K was a little bit high for this end of December just because there were several ETFs that actually got 5-week periods. This would have likely been closer to about 40,000, but it's still down. My month-end yield, as reported by Snowball on December 31st, was 33%. I'm now at 27.62%. Again, it's because of the drop in distributions being declared by the juicers and the boosters for the most part. The anchors have been very stable with regards to handing out their distributions. So we're seeing the drop more on the boosters and juicers because their NAVs are dropping. My ROI and IRR, as reported by Snowball Analytics on the main page, I will show that again. Back a month ago, it was at 31.9 ROI. I'm now at 26.9. My IRR at month end back then was 20%. I'm at 17.18%. My 12-month projected monthly income, it's the delta from previous month, is down 8.9 thousand. So I was projected back December 31st by Snowball that my average monthly income going forward projected it was 41K. I'm now at 32K, a major drop, down 8.9K per month. Again, it's because of significant drops in the juicers and boosters. distributions. I do anticipate this will actually go even lower in February. I could actually see me down in the upper 20s, upper maybe 27,000 next month. So this is average based on what it's got now, projected 12 months. So it's a little corny saying whatever you got this month, generally that's going to be what your average is for the next 12 months. So, but anyways, it's around 32,000. Whoops, I didn't want to do that. Hang on, let's go back. Okay, my portfolio holdings, top 3 on ROI. So I did move up. It's going to change a little bit. I did move up from 37 investments to 38. I still only have 3 stocks, but I now have 35 ETFs again. I used to have 34 last month. I had 35 the month before. So I'm back up to 35. But the top 3 cover call ETFs in ROI. Call is still on top at 75% ROI. Bank is still number 2 at 70% ROI. But PLTE has dropped out of the top 3 position because of its recent drop in its NAV. So it is now dropped out. HDIV is now my number 3 in ROI at 68% return on investment. The last thing I put in here, this is, you saw this already in my previous slide where you show how Snowball does a compare of the stocks, anchors, boosters, and juicers. This is coming from my spreadsheet that does pretty much the same thing. It actually is more accurate because it's actually doing it right down to right down to the dollar. So this is my spreadsheet's analytics on the same pillars. It's showing here where you're saying, it has, it says 40, but I don't know why it says 40. It shouldn't be 40. I don't know. I have to check that one out. It should say 38 here. So anyway, I'll figure out why that's saying that. So, I know why. It's saying it because I do have a couple ETFs in here that are basically empty. So this one's lying with regards to this. It is 38. I have 2 empty rows in my spreadsheet. So anyways, it's showing basically the difference. The big thing I want to show here is that you could see my stocks went from 17 down to 14% over the past month. My anchors have gone from 29% to, as you saw already, 36%. My boosters went from a 25% weighting to a 24%, so it didn't change much. But definitely my juicers have had a major drop from 28% of the current NAV to now only 22% of the current NAV. All right. Okay, now we're going to look under the hood, and what I'm going to be doing is jumping back and forth between this presentation and my Snowball analytics so I can actually show you live data. This is my PIIverse portfolio in my Snowball analytics. So what you're going to see here is live as of right now. So this is the one I actually keep up. So let's go. So okay, so I use Snowball Analytics for those. I'm just going to outright say this. I'm an affiliate of Snowball Analytics since November of last year. Anybody that likes Snowball Analytics and gives it a try and says, hey, that's pretty cool, I would like that, mention my code, my promo code, and you will get 10% off if you decide that you want to subscribe to something, and I get a little bit of a reward on the revenue from it, and you get 10% off on your subscription. So just give you a heads up. I am not advocating that you do buy this or get into the subscription, but if you watch this subscription, this presentation, and say, hey, that's pretty cool, then hey, more power to you. You get 10% off. All right. It will be link pinned to the top of my comments if anybody wants to see what the promo code is. Okay, so let's go. So first thing I'm going to do is talk about my diversification, because again, a major strategy towards a healthy, sustainable portfolio is one that's very diversified. So we're going to do a little bit of work on the diversification aspect of it. And let me just go find this for you. Hang on. Forgive me for this. Okay, we're going to switch over. Okay, so this is my Snowball Analytics for those that have never seen it. So this is the main dashboard here. Again, you saw these metrics already in my previous slide. This is where these numbers come from. This shows you my book value. This is my current value. This is my total profit, I currently have an ROI at 27%, and that's basically my unrealized losses, my capital gains, and my dividends all added up comes to about 27%. I will hover on this right now, so if anybody wants to see it, these are the breakdown of what makes up the 27%. My capital gains basically is a $500,000 loss. My capital profit loss realized is from my sales, of which I've gained $45,000, and my distributions since inception is just over $1 million. All right, so what I'm going here, because we said we're going to talk about diversification. We already looked at this. You already saw this. The important thing I wanted to point out here that I never talked about in the previous slide was not these ratios of 33 and all these numbers here. It's how well these different pillars perform. You can see right now that the gain on my anchors right now has an ROI of 56.61%. Again, it doesn't mean it's the one that generates the most amount of income for me, but it is the one that has the best ROI. It's 56%. Ironically, the boosters and the juicers, even though the boosters are supposed to be more stable because they don't use single stock underlyings, they actually use composites like an index or a composite or some form of aggregate multi underlyings. They should be more stable, but as you can see, their ROI is not much better than the boosters, the juicers, their current ROI, because, and again, this number was much better a month and a half ago. The crypto chill, crypto winter, because a lot of these boosters and juicers have a lot of crypto in them. They have a lot of tech in them. And that's why they actually generate so much yield, is because they're going after higher volatile underlyings. And of course, when they're doing that to generate higher yields, that's where you're going to pay the prices. When you see major market downturns, you see risk off sells, and we're seeing a lot of risk off on the markets. Any markets, anywhere where the investors feel that 2026 something's going wrong in the economy and I'm starting to pull back and either retain my cash or move to more stable environments and stuff like that. So the boosters and the juicers are feeling that pain. You can see my ROI on my boosters are 4%, and my juicers are just about the same at 3.66. My growth stocks, again, Athabasca is my absolute darling. My swing trading on that for the last 2.5-3 years has been amazing. And so I'm at 103% ROI on my growth stocks. Okay, so I wanted to go into my analytics under diversification. That's the more important part for this one here. I'm going to put this screen up. If anybody, people always say, well, Perry, what makes up your portfolio? I'm going to put this screen up. I'm not going to keep it up forever. This is what's called the buy-in. So you see I've check marked buy-in. So what this says is this is what my portfolio looked like at the time when, I'll say at my book value, not at my current NAV. This is my book value. These are the percentages of weight on each one of the ETFs that I have. Some of them are brand new, like my C-Day, just what didn't even exist on Monday. It now is 3.43% in here. So some of them are pretty new, but these are my current positions at buy-in. Okay, so you froze the screen and you looked at it. Great. Now these are my same positions at current value. So current value is what obviously current NAV. This is what my position is right now at current NAV. So if you look at right now, you could already see C-Day moved up from 3.9 to 4.66 because a lot of the juicers and boosters today took a major hit, especially if you owned anything regarding crypto, Bitcoin, or Robinhood. You got hit really hard. And I do have a few of them, so a lot of them dropped down big time. Of course, you couldn't hide from anything. Today was bad almost everywhere. But anyway, so this is my portfolio's diversification as of current value. Okay, so I'm not going to do any more there. You can see Athabasca is my number one stock and my number one investment. It's the only one over 10%. I am very much, for those that don't know me, I believe in heavy diversification. I believe in generally not having anything over 5% holding weight. You could see that only 3 of my ETFs or my investments actually exceed 5%, and that's Bank, ENCL, and Athabasca. They are all darling stocks of mine or ETFs of mine. Everything else is under 5%. And you can see that here. The riskier they are, a lot of times the smaller they are in my weight position. So for example, MSTE, well, I mean, everyone knows about MSTE or MISTI or any of the ones that are based on MSTR. They're really taking a kicking right now. But the thing is, even if MSTE basically just fell off the face of the earth, or MSTE, it's under 1% of my portfolio. I wouldn't want to lose it, but if it's lost, it's lost. So that's my portfolio right now as of current NAV. Okay, so the next thing we're going to talk about here, let's switch to the next one. We're going to talk about distribution. So all you've seen in the last one was my diversification. We're now going to look at my current, as of this month, my distribution makeup that's happening right now. Some of the things you're going to notice in here is that my juicers are still producing by far the vast majority of my portfolio monthly distributions. Even though they're taking a hit badly, they are still the one generating most of my income. So let's go over there. I'm going to switch over here to dividends. So this one shows you who's generating the most income. Yield payouts. It's done currently by ETF or by stock holdings. You can see here, this is my yield payout. So again, a lot of these are the yield and yield on cost. When you see the bar down here, it means my yield on cost is far below its current yield. So its current yield, if you bought it today for say CNYE, is 93%, but its yield on cost in my portfolio is only 34%. On the other hand, if you look at someone like Bank, its yield is only 15%, but my yield on cost is 20% because I actually bought it when it was cheaper and it keeps going up in value. So my yield on cost keeps getting better. If I switch this to categories, you see a much more important thing because I really don't want to focus too much on ETFs. I focus on categories, pillars, and the strategy. This is the big one. So even though juicers and boosters, as you saw previously, they only were generating an ROI of 4%. Remember, I'm a consumption investor. Therefore, one of my number one priority is how much income can my portfolio successfully sustain and maintain. Well, when it comes to income, you can see here that my juicers have a yield of 54% yield. And if you look at my anchors, they're only at 17% yield. Now, what you do also see is that they are taking a major hit on yield on cost. So even though my yield is 54%, you can see that the yield on cost is 23.9. They basically have eroded a lot or lost their value right now. Again, if the crypto chill in that, all the markets come back up, this will all start climbing up. But anyways, and you can see on anchors, I'm actually above. My yield on cost is actually better than my actual yield. If I switch this over to annual payouts, this is showing my income generated on my three categories. So currently, you can look here, my juicer's annual payout is $168,000 of my portfolio comes from my juicers. All right. If you compare that to my anchors, 90,000 of my annual portfolio distributions come from my anchors. So my anchors are definitely more stable. They're definitely much more rock solid during bear markets and stuff. They're not volatile, but they also only generate about 23% of all my dividends, whereas my juicers generate 43%. My boosters generate 32%. So yes, he is the wild Bronco horse to ride, and you got to be ready for some major nosedives as well as high, increase ups. But they are generating a lot of my monthly distributions and my annual distributions. And I'll just show you here again. If anyone wants to freeze it, this is my annual distributions for my boosters and versus their invested value, and this is my anchors right there. Okay. So that's about it for distributions. I don't think I have anything more here. Oh, sorry. I want to keep going here. You can see also in here, this is my projected for this year going forward. This is February right here. Remember I said I made around, this is February, so this is current month. They anticipate it'll be 30,000. So this is, if things don't get any worse, they're looking at I'm at around 30, 32, 34,000. So there's my monthly average over the next projection of 32,000. And what else? This is showing you my distributions all time, even ETFs that I've sold. I've exited Coney back about 3 months ago. Coney still is the top income generator of all times. It's going to still take a lot of time before someone like PLTE or somebody else comes and catches up. MSTE or MSTY, which is really hurting right now, it has also been a major contributor at 80 almost about $81,000. So these are my two top dogs. Coney will likely be my top dog for, even though I don't even hold them anymore, for several months to come before anybody else actually challenges it in being the top distribution generator. And this, just for anybody who wants to know, this is my 2023, 24, 25, and 26. 23 is now gone. So it just started for 2026. So you can see, I anticipate 2026 is going to be a bear market. So I don't see that these purples are going to be beating this blue. I have a feeling we're going to be seeing lower numbers throughout all of 2026. Again, my strategy for my income portfolio is designed to handle this. Would I like to see my income generation go higher every year? Of course I do, but we're in an economy that goes up and down, and we also have incomes that go up and down. My portfolio is designed to deal with these lows. So yes, I don't anticipate that my purples or my 2026 are going to beat my 2025s. They'll likely be lower throughout the entire 2026. But the good part is they generate over 3.5 times, 4 times more than I need on a monthly basis. So I have this is what I refer to as my LEPB. My living expense protection buffer is set at 3. I'm well over 3. I'm almost at 4, around 4.5. So that means basically I'm generating 3 to 4 times more money than I need to live on for my retirement. So the markets could go down quite a bit more, and I'm still protected. All right, let's go back to the next one. Okay, so now we're talking about growth. This is what the growth investors, again, I'm an income investor. I'm a passive income investor. So my priority is income. I don't look at NAV on a daily basis and say, oh no, I'm hurting. Because again, NAV is just sort of like a cost of generating income. Do I like to see my NAV drop, 10, 15%? No, of course I don't. But the good part is, even though my NAV is down, like it said, 26% over my book value, I'm still generating income every week. It still comes in. Yeah, it's lower than it was, but there are growth investors out there, quite a few, and they want to know those numbers. So let's go look at my growth and compare it to the growth portfolios, like the S&P, which is our benchmark everybody uses. All right, so let's go over there and take a look at that. So I'm going to go into my Snowball analytics, and I'm going to go over to the growth category. So this is really cool. I don't want to show you this yet. Let me show you this. No grouping. So this here shows what my portfolio looks like. I've got it set to 1 year. So this dotted purple line is my book value. It's not cash is not included in here. So when you look at these numbers, if I'm holding a lot of cash, that value is not in here. This is invested portfolio or portfolio investments, not the cash balance itself. So this, you can see it goes up and down quite often. And a lot of that is because of reinvesting. It's because of rebalancing. For example, whenever I do a swing trade on my Athabasca and I sell, say, 10,000 shares and I actually take out $80,000 in cash from it, you're going to see a major drop. Like you're going to see a drop from here to here. Or if I'm now actually doing a swing buy and I'm moving my Athabasca back in at a lower price, you can see a major increase like you can see right here. That's because of swing buying and selling. So this is my book NAV less cash, what you're seeing here. You're seeing a major drop here because I actually just recently told you that I did a major swing trade sell 3 times. So I went down about 9,000 shares. So that's what you're seeing, the major NAV drop there. But that's not the important one. The more important one that people want to see, the yellow line is my total return on my value of my portfolio based on compared to the S&P. So the good part you see here is, again, I'm an income investor. So as long as my S&P keeps flying, as long as my portfolio stays relatively aligned to the S&P's line, that's all I care about. I'm not looking to beat the S&P. There's no kind of reward for being the rabbit or the turtle or the hare. At the end of the day, I'm looking to make sure that my portfolio, thanks to proper levels of reinvesting in that, basically keeps my NAV at a level so that it actually stays in alignment with the S&P. So you can see here, some days I'm actually beating it. Like last summer, I was definitely beating it, and of course, ever since November of last year, when the crypto chill and the tech chill started happening, you can see a major drop from late October, where basically the S&P stayed pretty steady. But because I have a very high yield and I invest a lot in crypto and in tech stocks, which are also quite leveraged, you're seeing that my portfolio has seen a major decline and actually came back in alignment with the S&P. So the thing is, even though I had the tech chill, you can see that basically the S&P held steady. My portfolio just came in alignment with the S&P. So I came down to its level as opposed to I dropped below it. Only in the last couple weeks has it really gone further, and I can actually bring that closer to you so you can see it a little bit better. You can see how the S&P is holding a little bit more steady than my portfolio. And again, it's because I do have a higher percentage of juicers and boosters, which have a lot of them with leverage and are taking a lot more volatility. So these are definitely being impacted by the crypto winter that's starting to happen, by the tech sell-off and the risk off, whereas the S&P is a lot more diversified and neutral, and therefore it can actually hold off. Even though it went down, it's holding off more than my portfolio. Again, just want to show that because people, good and bad, yes, my portfolio is dropping. It's quite clear it's dropping. It's expected during that. But now if I want to show you this based on my grouping of my categories, this is a really cool thing. Now you saw my entire portfolio. This is my pillars. And what's really cool about the pillars is it shows you which pillar is performing the best with regards to growth. So if you look at my anchors right there, that's my anchors. Let's make it year. Let's make it 1 year. You look at my anchors and you can see my anchors are generally holding their own. You see some drops. A lot of times that might be because not just because the market declined on the anchors. It's also because I might have sold some anchors and moved them into a juicer or a booster. So for example, you see right here, you see a major drop here from May to June. That could have been, I don't know for sure, that could have been because I actually sold some of my anchor position and moved them into a booster. That could be what it is. But what you generally see here, which is important, is when it comes to anchors, look how stable it is over the past year. Now you compare that to the boosters, and there's the boosters. They're actually not doing too bad either. But what you can really see at the very last and at the tail end, and that's where it's really telling, is right here. When we're now starting to see the tech sell-off, we're seeing the crypto winter hit. This is where the anchors shine when it comes to NAV versus the boosters and the juicers. Look at the booster. You're starting to see it go down. Now, because boosters are made up of composite underlyings like indexes or sectors, it goes down more gradually. Now, if you go and look at juicers, juicers were the rock stars in 2025. You could see it outdid all the others, but you can also see in the last 3 months, look at what it's been doing. It's been coming down. It's already dropped below my anchors. It's headed now below my boosters now. So it's the one that's paying the price because it is single stock underlyings, much higher yields, more leverage. Those things are basically hitting it a lot harder, and therefore you can see the difference between the pillars. And that is why, knowing that 2026, in my personal opinion, I felt it since November, that with the economy and all the craziness going on in the U.S. Right now, I felt that the U.S. economy is going to really go for a downturn. And if it does, the world will likely go for a downturn. And that's why I want to start moving a lot of my portfolio more towards my anchors. And And that is the reason behind my strategy to start moving my weighting of my anchors higher into the 40-45% range. I will not be generating as much income. I know that. But look at what I get to see. I get to see a lot more stability over this dark period versus the juicers are likely going to be getting only worse over the next few months. This is my portfolio growth on this one. So again, this shows you my growth position. You can see nice thing for my anchors. It's just a solid, other than this was Liberation Day here. You can see how everybody got hit there. But what you can see when you see since Liberation Day, look at the anchors. It's been a solid, nice march upward. When you look at the juicers, you see it go up as well, but it also is dropping down like a stone over the last month and a half. Okay. So this is the important thing to see. This is why it's so important, in my opinion, to actually break your portfolio apart into anchors, boosters, and juicers, and stocks. If you have growth stocks and dividend stocks, you can create your other categories if you want. But this is great because I can now visually actually appreciate why I want to move towards move towards anchors and that kind of stuff. Okay. The last thing I want to show you here, this is an important thing. This is all because of the sell-off. If you look at my video back in October, my month-end October, all of these would have been green. There would have been only 2 reds in this entire portfolio. Everything else would have been green. You can now see, because of the crypto winter, the tech sell-off chill, and all that stuff that's going on here, the risk off and I bet you this actually was down to here in green. It only in the last couple of weeks was this number actually going to where it is right now. This is showing you quite a bit, where it is. So I'm just going to show you. These are all my holdings based on their total return, or ROI, and COIW right now is at minus 53%. Again, that's one that if the Bitcoin and the crypto environment does recover, COIW will be one of those that will go up. That's why I got out of Coney, because Coney would have likely capped out. COIW would likely not, and that's why I as bad as it is, I think it's the one that might recover if the crypto environment recovers. So anyways, there it is. Here's our rock stars: Call, Bank, HDIV, HYLD. All of these 4 are all anchors. They are my rock stars for stability. Okay. Okay, I think that's about it. I'm not going to talk about any more about that one. Okay, so let's go to, I'm not going to do my Snowball report. They still need to do a little work on it. I do like where they're heading, but there's nothing in there right now that I really want to show until they actually just clean it up a little bit more. So I'm going to leave it alone. All right, looking forward and conclusions before we get out of this. So first thing is, I am going to continue to execute my stated 2026 strategy of shifting to stronger anchor weighted portfolio. I think I already stated to you several times, I want to maybe move that up even to about a 40-45% anchor weight. In anticipation of the 2026 bear market, I'm building up cash reserves in 2026. I didn't do it in January, as I already told you, but I will be starting to pull back on reinvesting. I want to build up a cash reserve, because if the bear markets keep going and their risk off position keeps getting worse and even deeper, which I do personally anticipate it will. That's my gut feel, nobody else's. It's your choice what you want to decide. I want to have cash in my hands, as a protection for myself personally, but also if there's some great opportunities to buy some really quality covered call ETFs, I would like to have the money to buy into them if I see them at a point where I just can't resist. Any reinvestment from monthly distributions will be directed towards anchors. So that's the other part of my strategy. When I do reinvesting, I will not be reinvesting in juicers, and likely not boosters either. Mostly, I might maybe do a couple, but for the most part, I'm going to be focusing on reinvestment into anchor positions so that I can build up my anchor positions. And I plan to open a Canadian covered call ETF position in my non-registered using my Athabasca capital gains. It's something I said I was going to do in November and December. It's something I still can do. And Athabasca just paid out a big portion, so I am actually sitting on a lot of cash that I could start doing it. I'm not incented to do it yet because the other part of that shoe to drop is that I want to see the bear market take hold more, because I think some of the really high quality anchors, which are Canadian covered calls, things like ENCL, HDIV, Canny, those ones there, all of the ones that I really do think are good, solid ones, I think they'll go down anyways too. So I might wait a little bit longer before I actually decide to do my first non-registered covered call ETF. And that's where we are. So in conclusion, my prediction in November of the crypto tech chill becoming a precursor of the 2026 bear market is starting to come true. I think it's really, everyone's seeing that starting to happen now. And unfortunately, I personally believe it's going to get worse in the next couple of months. So it looks like my predictions are true. I'm glad that I started my strategy already in December. So my strategy to reduce risk of my portfolio by moving my weights to anchors has already started. And I know it will be a rough year, but as I already mentioned, my LEPB buffers should protect my monthly income needs for my retirement. Again, it should be. If it doesn't, I think the whole world's in trouble if that's the case, if we drop another 300%. So anyways, I do believe my strategy will hold its own during these dark times, and we'll see where we go with this. But I do feel comfortable that other than having to expect a lower distribution on a monthly basis, I should be okay. All right. I hope you found this monthly review interesting. Please like, subscribe, and leave comments. I know some people will be asking a lot of questions. Again, I apologize for anybody that says, where have you been for 2.5 weeks? Now you know that I was on vacation. I wasn't hiding from you and running scared. I will be starting to create some videos again. I've got a backlog of a few videos I actually want to do, especially with the bear market, the way it's starting to show up right now. So I do want to talk about some of the major moves I've done recently, and you should be seeing more videos from me over the next, several weeks to come, now that I'm back from vacation. All right. And until next time, stay safe, stay investing, and I will see you in the PIIverse.